Every investor needs to have an understanding of risks. But most importantly, every investor has to have an appreciation for their personality, their psychology, and how they react to risk. In today's session, I will be talking about risk aversion. It's a concept that has come from various branches of finance or behavioral studies or psychology. I'll keep it simple. It simply means understanding yourself, understanding your personality, understanding the attitude that you have and that you bring to the process. For some people, they might be more risk averse than others. One of the misconceptions that most of us have is to believe that some people are risk averse and some people are more prone to taking risks. We are all risk averse, like a log scale, or what might say a sin ratio, or a linear line is simply a case or a question of your degree of risk aversion. Risk aversion simply means, to put it in a very simple example, some people will feel the loss of £10 much more than they would a gain of £10. In investing, one of the things you have to understand is how you will react. It's difficult to know until the event has occurred. However, it's easy to understand the options available for you and to tailor your investment approach to suit, I would say, something slightly consistent with your personality, your principles, your lifestyle, and most importantly, your age. Now, in the previous session, I talked about categories of assets, asset classes, or asset types. And I tried to link asset types to the principle of speculation, investing, but also I tried to link it to valuations and pricing. Now, in today's session, we're taking a little bit of a step further. We've now identified what I consider to be some of the fundamental ideas to begin your investment journey. I'm going to talk about you, the investor. Understanding yourself is one of the most critical parts of the process. Recognizing your uniqueness, recognizing how you differ from every other person. You need an investment philosophy. We talked about that. You need to have a set of principles or guiding beliefs or values or rules you bring to the investment process. We talked about that. However, one of the things to understand is yourself. I'll use examples that might be easily remembered, but I think today's session in many ways marks what I believe is a turning point in how you move either towards a particular strategy of investing or the steps you take. I'd like you to think of 3 different scenarios. Number 1, your age. You're 20, you have a good job, you intend to work until you're 65, and all things being equal, providing that there's grace and there's good luck, and looking at life expectancy, you live till 85. At 20, you might have the very rare opportunity. I say rare simply because over centuries and over our knowledge as human beings living on this planet, we are living the longest. At 20, if you go back to the 1930s and the 1940s, if you live beyond your 20th birthday. It was something to celebrate. So we know that we're living longer today. Life expectancy for the average person, depending on where you live, is far exceeds 75, especially in the West. At 20, you might have an extra 40, 45 years to work. Now, that is scenario number one. You're 20, you have a good job, you're intelligent, you're ambitious, and you have 40 more years to work. Therefore, if you're trying to begin your investment journey, you might consider yourself to be in a position whereby, even if you lose £10 invested, you have a lifetime to make it back. And the beauty of compounding still exists. It can still work in your favor. On the other hand, if you're 45, you've worked most of your life, you do not have so much more time left. You might be able to work for an extra 20 years or 25 years. Therefore, you might be a little bit more cautious about what you do and how you deploy your capital. Scenario number 3, you're about 55 or you're 60. You're very, very closely approaching retiring. Therefore, you do not have enough time left to make back any loss as a result of decisions within your control or out of your control. Therefore, your risk appetite might be slightly different. Now, the reason I use that example is to simply say, in understanding yourself, the first question you begin with is, who am I? Where am I in my working or investment career or my working journey? Am I in what I would call the pre-stage? Am I in the first stage? Am I in the second stage? Am I in the third stage? Or am I in the fourth stage? Or am I actually post the game show? Am I already retired? Depending on where you are, depending on your liquidity, depending on your sources of income, you might choose a posture that is more appropriate for that particular place where you find yourself. So risk aversion is simply making a choice, deciding to be a little bit more conservative or be a little bit more risk-seeking. What that simply means is someone who is 20 has the time and can afford to take more ambitious opportunities, more prosperity-driven or growth opportunities. Someone who is in his 60s might be a little bit more conservative. You might choose opportunities that are more guaranteed, that provide safety and reduce risk. I'll use another example. Imagine yourself driving in a car. A car goes from 0 to whatever the maximum range might be. Let's assume 200 miles an hour. You can change the speed as you drive depending on the street on which you drive, depending on where you live. If you live in parts of Europe, you're allowed to drive on motorways where you can drive as fast as you want. However, within the city, within the local area, you might be confined to driving at 20 miles an hour. I'll give you a good example. As you leave my street, on my street, the speed limit is 20 miles for every hour. That means you're expected to drive very safely. As you exit my street and join the adjoining street, it's 30 miles an hour. Now, if you keep driving and you head towards the motorway, you get to a point where you're allowed to drive a little bit faster at 40 miles an hour. When you get to the motorway, you might be able to drive at 50 miles an hour. Eventually, you get to a maximum speed of 70 miles for every hour. Now, each and every single area provided a limit. I'd like you to think of your investment career or yourself as a car being driven on a street. We'll play that in reverse. You're on the motorway, you can go as fast as 70 miles an hour. But as you come closer home, and as you get closer to where you call home or where your destination is, you start reducing your speed from 70 to 60 to 50 to 40 to 30, and as you come into the street, 20. Now, the point of that is, on that scale is risk aversion. meaning you can reduce your risk and you can increase your risk. There are times when you should be able to be more conservative, and there are times when you should be able to be more aggressive. I haven't explained the role psychology plays in the market, and I haven't explained how to understand cycles. There are times in the market where you have a lot of optimism, and you have a lot of greed, and you have a lot of hope. You might even have a lot of capital being allocated in the market. In other words, the psychology of the market is optimistic. If you're a conservative investor, at such points, you should travel a little bit slower. So you should move or allocate your investment portfolio to assets or opportunities that are a lot more conservative. It simply means that you can put risk on and you can take risk off. It's like, driving. You can increase the acceleration in the car and you can reduce it. There are other times when the market is pessimistic, when there is panic, uncertainty, worry, fear. John Templeton says the best time to invest is when there's blood on the streets. In other words, everyone is fearful. Warren Buffett says, when other people are greedy, you should be cautious. When other people are cautious, you should be greedy. In other words, when other people are fearful, be greedy. When other people are greedy, be fearful. In other words, the more prudence or that other people conduct themselves, or rather put in a different way, the less prudence with which other people conduct their affairs, the greater the prudence required on your part to conduct your affairs. And that simply means risk is not something that stays even. It's something that you regulate, you balance, you mix, you adjust, you modify. There are times to put risk on, and there are times to take risk off. What I would like you to take away from today's session is that understanding your personality, understanding your psychology, understanding your dreams, your goals, understanding where you are in the market cycle, understanding the psychology of the market, the attitudes of the people and the participants in the market. All of those items enable you decide what level of risk you should be taking. Let me make it a little bit more practical and closer to what we're going through today. We have a public health crisis as a result of the virus, the COVID-19 virus, or some people call it the coronavirus. As a result of this epidemic, the economic markets have been very, very, very strongly shaken. Consequently, we've seen companies and assets priced at different valuations. There's a mispricing in the market. Now, it's not my intention to go into whether I believe the market is overpriced or whether the market is suitably priced. All I can say is that there are dislocations in the market today, and it seems that the mood in the market is fear, uncertainty, worry, anxiety, somewhat depression. Therefore, you can, providing that you've established a principle that you will not deviate from, providing you've identified values, tenets that you will comply with, providing you have a philosophy that will guide you at all times, you could decide that this is the time for you to put risk on rather than take risk off. Now, if you go backwards 4, 5, 6 months to say January 2020 or December 2019, anyone who had studied economic history will tell you that we had been in what I call the late stage of a cycle. And that simply means that if you'd studied economic cycles and market cycles, we were in the 11th year. By December, we were in the 11th year, and I believe the second month of the longest market boom or boost or upcycle. And therefore, at that point, everyone was excited, everyone was euphoric, everyone was feeling greedy. There was too much capital available, which is something to be very, very mindful about. Whenever you have too much capital available, it means that the market is probably high in its cycle. So in December, January, the market was too optimistic, like a pendulum that swings from left to right, from euphoria to depression, or from greed or envy to despair. Understanding where you are in the cycle enables you to choose the level of risk aversion you should have in your portfolios. So in January or December last year, whilst the market was optimistic, you could have said, because of the optimism in the market, because of the availability of capital or cash slushing around looking for opportunities for them to be invested, you could have said, because of the behavior of the participants in the market, that was a good time for you to take risk off the market. In other words, you adjust your portfolio in such a way that it's a little bit more safe. So in today's session, I'd like you to go away with, I'll say, 3 very specific assignments for you. You can call this take home assignments. Number 1, I'd like you to get a piece of paper. And on that piece of paper, I'm going to ask you to ask yourself some simple questions. These questions will be very easy to answer because you're doing them on paper. These questions will be much harder in practice. Question number 1. How would you feel if you invested all of your net worth and you lost 5% of your net worth completely? How would you feel if you lost 10% of your net worth completely, never to get it back again? And how would you feel if you lost 25 or 30% of your net worth? That's the first question. Second question. If someone offered you the opportunity to invest in an asset, a company, and they said to you that the return on investment would be 4%, but the company is what we call an AAA rated company. And that simply means they have the best credit rating, but also offered you an alternative opportunity, 17%. However, the company had a credit rating of a D, and that simply means it's verging on the edge of bankruptcy. It does not have enough financial support, either in enough cash, low debt, good management. This is a company that is not very safe. You might call it a junk company. Which would you choose? The 4% that is safe, secure, with your original capital protected, or the 17% where it's a promise, your capital is at risk? Which would you choose? Now, those 2 questions should be simple questions that you should ask. I'll give you a third one. And this third one is not in no way going to make any, the first 2 in principle should give you an idea about your psychology and the kind of person you are, whether you enjoy risk or whether you don't. But this is number 3, very, very important. How would you feel about investing in a company, private company, or a public company, whereby the company or the assets has no quoted value on a daily basis? In other words, let me use a good example. Look at the stock market. You can buy a stock in the market and you can check the price of your investment every single minute or every single hour, should you choose to. If you were given an opportunity to invest in a company where you could see the performance and the price, the change in the market price of the company on an hourly basis or on a minute-by-minute basis. That's the first. The second, you were given the opportunity to invest in a company whereby it has no quoted market price. In other words, uh, you invest the money, and you just allow the business to generate profits. You're not checking every single hour. Which of the two would you choose? Now, the three questions are there to help you understand yourself better. I would say this so you can understand. In the last session, I talked about life cycles, and the importance of life cycles, and how businesses go through life cycles, just like people go through life cycles. The reason for those three questions is simply to get you to recognize that human beings or investors also go through life cycles. There's a time when you're born, you grow rapidly, you mature, and then you start to decline, and eventually you die. So depending on where you are in your life, you can put risk on, increase your risk, allow your risk to be reasonable, and then start removing and taking risk off your portfolio. And at some point, you should have potentially no risk. Now, asset classes, like I explained yesterday, have different levels of risk. If you want your money to be riskless, you can put money in cash. I talked about different forms of assets in the previous session. I talked about assets that are denominated in a currency, cash or bonds, money market funds. In the UK, we talk about things such as ISAs, effectively just savings. Those are assets denominated in a currency. The second types of assets, or group or category of assets, are assets that do not produce any income. We call them non-income generating assets. In other words, these are assets that you buy with the hope that someone else in the future pays you more for them, like gold, art, paintings, or any other collectible. They do not generate any meaningful cash flow by themselves, but you hope that someone in the future someday will pay more than you paid for it. Those assets have a different level of risk. And then I talked about the third group of assets, which are assets that produce income. A piece of land used to farm, real estate where you rent out the buildings. I talked about a business where it generates earnings. Now, each of these three categories of assets come with different levels of risk. The first, cash. In principle, you might argue that there's no risk if you leave your money in cash because you can see it. Bonds are more safe because you can buy a government bond, which is considered risk-less. But as you travel up the other two categories, like gold and art, and businesses and real estate, they come with a level of risk. And so today's session was simply to give you a context about the importance of risk aversion. I don't want you to feel as though being too conservative is wrong. As a matter of fact, the greatest investors are usually conservative. They understand when to be aggressive and when to be defensive. And that's probably one of the best strategies to adopt. Biblically, if you go down to the ancient books and they talk about the book of Proverbs, King Solomon said that there is a time for everything under the sun. There's a time to be born, and there is a time to die. There's a time to laugh, and there's a time to cry. And if you look through life, and you look at the universe, everything moves in seasons. Winter comes, it goes, and summer comes, and it goes. Likewise, in investing, risk should be put on, and risk should be taken off. Understanding when to do that allows you to become a master at what you do. In other words, you become excellent. But the process of doing that takes time. It requires study. It requires discipline in many ways. It's not something that can be done casually. And this is the reason why you need a philosophy, a set of principles, values, or tenets that you stick to no matter what season. So, key thing to remember: study yourself, make a list of the qualities that you believe define you. In many ways, do you know what I think you should consider? If you have close friends or trusted companions or people in your inner circle, you can find out more about yourself by asking those people questions about you, such as, the qualities, the best qualities they see in you, in relation to money, what they believe about your temperament, what they believe about your character, what has been their observation about you. And you might start to find, or you might start to glean from their perspective about yourself. But the key thing to remember from today's session is this: you must understand risk. You must understand your level of risk appetite, whether you're more adverse to risk or whether you're more happy, depending on where you are in your life, to take more risk. Using the example I used earlier on, like a speedometer of a car, there's a time to go fast and there is a time to go slow. The key is understanding and recognizing which is which, and when you should put risk on and when you should take risk off.